What's going on, everybody, and welcome to, I'm going to call this the Enigma. Basically going to take you inside of the trip of my brain over the next month and a half. I will be adding to this. This is the lesson one of minis. First things first, I want to open this up and say thank you guys for your support. Without you guys, I would not have been able to bring the Juicy Trades project to life. I'd have just been trading in my desk, which would have been cool either way. But this has been a very fun experience to be with you guys, to trade with you guys. So this is, for me, this is a pleasure to do, and I'm glad that you guys are here. With all things said, now, if you're coming into this mentorship, this is going to be the first place that you start. What you want to do, and again, some of my viewers here are more experienced, so this is a very basic lesson, okay? But if you're new to Juicy Trades, watch this lesson. This will be quick. The whole premises of this mentorship is for you to watch these lessons and be on our live stream trading. Our live stream trading can be found under the live stream tab in the announcements channel. I will announce where I'm at. It's under it right here. In the announcements channel, I always announce where I'm at, and I'm in one of these streams, okay? So with that being said, we're going to go ahead and drop the music a bit, and we're going to go ahead and get into this. So a little bit about myself. Xavier, also known as X in the chat. I'm an 11-year trading veteran. I used to be a former advisor, or worked my way up from teller to advisor, and while I was doing that, I was learning how to trade in trading. When I became profitable, I pretty much just threw all that away. Actually, I threw it away before I became profitable. The financial advising thing, I actually had to go back to it after I blew an account. We're going to get into that later. 8 back-to-back green years, leader here at Team Precision. I've coached and worked with over 500 students of all various talents. 80 of these guys and gals are now running and owning and operating their own Discord. You might see some of them on Twitter. But long story short, you're in great hands. So getting into it, here's a disclaimer. Juicy Trades is providing this slideshow and any related materials for educational purposes only. We are not providing legal, accounting, or financial advisory services, and this is not a solicitation to buy or sell any options. Long story short, this is for education purposes only. So we're gonna go ahead and get rolling with this here. One thing I do have to say, a few of these concepts and the materials in this course have been shaped by the teachings of Michael J. Hudson, also known as the Inner Circle Trader. It is also recommended that participants in this mentorship have a very basic understanding of the 22 series, which can be found for free here. Here's the YouTube link. Here's the site. Now, I'm not going to go back until you go back and watch the whole 22 mentorship. You don't really need to watch anything else but what I'm about to create here. But if you have a ICT foundation, it will help you excel in what we're about to do. So get into it. The agenda of the day, we're going to be short, sweet, and quick here. First things first, we're going to go over funded accounts, what they are, the advantages of them. We're going to go over the concepts. Now, concepts for me, to you, are just a piece of a puzzle. Now, we'll be talking about that throughout the mentorship of this course, but they're just pieces of a puzzle. The strategy is what puts these concepts together. But today, we're going through the basics and just going through some of the basic concepts, okay? Which will be supply and demand zones, which is also known as order blocks, and how to use them. We're going to go over the fair value gap. We're going to go over the inverse fair value gap. We're going to go over kill zones, and then we're going to wrap it up with a recap. So let's take a trip back in the day. Back in the day when I was trading, like when I first got going, you had to fund your own account. You was either simulating trading and not really making any money, and that's cool. You're building skills in that phase, and we talk about that throughout the course of the mentorship in the previous videos. But, in order for you to make money, you had to risk pretty much your money. So let's say you made 100K in a year, which the majority of people nowadays do not make 100K in a year. And then you put 25K into an account, PDT, that's the 25K for stocks. And you get around it with trading futures and options. But for example purposes, you put 25K inside of an account. So that's 25% of the net worth that you made that year into an account. So 90% of traders fail. So imagine blowing the whole account. Like, how devastated are you? Like, how crazy do you feel? Like, I want to just take that and just give you guys a reminder when you hear things about prop firms, right? Because the other alternative for a lot of new traders is to go ahead and trade their own capital. Well, if they're newer and they trade their own capital, even with a plan, emotionally, things can happen and emotionally throw you off, and you can do a lot of self-destructive things. I'd rather you do that on what's called a funded account. Now, funded account, here's a long textbook definition of it. You can either read this or listen to what I have to say. A funded account is between you and a prop firm. Now, we like Apex and Top Step, and I'll go over that here in a second. But a prop firm is typically where the firms that we deal with are futures firms, American-based firms. In fact, if it doesn't have NinjaTrader or Tradevate attached to it, I won't even consider trading for that firm. Why? Because all futures contracts are dealt with through the CME. So theoretically, unlike the Forex markets, which are heavily unregulated and heavily manipulated, not to say there's not any manipulation here through the CME and the futures markets, you are trading from America. You're not trading some risky prop firm that's like based in Spain. That's the equivalent to you living in America and doing an offshore broker. It's risky. It doesn't make any sense. So if you are going to trade prop, in my professional opinion, you should be behind a futures-based prop firm, and you know they're a great firm because they offer NinjaTrader and Tradevate. And the crazy thing is, those firms that offer NinjaTrader and Tradevate, you can also trade Forex through those firms, the majority of them, which is crazy. And people just, I don't know. Getting back to it, a funded account is an account that you earn from passing metrics from a proprietary trading firm, desk, or funding program, meaning that there's going to be a test of simulated trading. And if you can make this much without losing that much on the trail and drawdown braces, we're getting that to a second, you may pay an activation fee, but in return, you get access to capital to trade with, sometimes up towards 300K. And for my more experienced and my more skilled traders, you have the ability to get up to 20 accounts at times. So for me, just taking that trip back, if I could go back in time and not blow any of the money I lost, real capital that I lost, and not have to deal with the high emotional lows that I dealt with when losing that capital, and focus solely here on funded accounts, I would have taken my trading to a whole different level. Now, the thing about a funded account, you should be using this as a stepping stone to generate income to put into a live trading account. So theoretically, you never risked any of your own money, and then you won't have to have any rules or restrictions, which we'll get into that. So like I said before, the top two firms I recommend, and again, you guys can find discount links to both inside the chat room. If you guys go here to the chat room, you scroll down to where it says prop firm links. I'm doing a good job of keeping everything up to date of the most recent sales of the firms that I like, and you guys can click and use that. But these are the top firms. Apex is trailing drawdown. It's going to be a bit harder. I like Top Step for beginning traders, for more experienced traders. I like ATF. Why ATF? Why Top Step and ATF? Both are backed by NinjaTrader. Both are American-based. And on top of that, let's just rewind all this together. Top Step's trailing drawdown is simpler, but you can only have 3 accounts so far as of right now. There's a rumor saying you can get up to 10 coming up in the future. Apex, you can get up to 20 accounts and put them all on Trade Copier and then roll with them that way. This is for more experienced traders. But right now, if you're brand new and just started, I want you to start here at Top Step and then transition into ATF, or you can try out both, whichever works best for you. But my recommendation is Top Step. Now, what's it look like? Here's Apex. All right, 150K account. You can trade up to 17 contracts. Okay, your profit goes to make 9,000. I mean, you make 9,000, you achieve the account. But if you get a trailing drawdown hit of 5,000, you have to restart and repay a fee. Now, I want to be honest, and I want to just explain both areas of funded accounts before we get into the concepts, because you guys that are coming into the program, this is highly appealing to a lot of people. I don't have to risk my own money. You know what I mean? And you're going to hear other people, I got funded, I got to pay out, those type of things. So I want to explain both spectrums of it. This company here, Apex, is going to make money in 3 different ways. 2 ways is fees. You paid $317 in this month for an opportunity to make 150, to have 150K to trade with. They're going to pocket that fee. Most people be honest with you, are going to look at this challenge and not take it seriously, and they're going to fail a couple times. That money goes directly into their account. They keep that. The firm makes that. That's one way the firm makes money. The firm makes money also if you get funded and you become A-booked, they're going to copy the trades that you take. When you take a trade, they have some algorithm that follows you with an unknown amount of contracts. I hear it's a lot. But if you get A-booked, they're going to make money in those two ways. And there's a evaluation fee. Now, people on the outside that's never really was involved with trading and never lost an account before real money, they're going to look at this and say, oh my God, I have to pay $317. For me, that's amazing. Because if let's just say I felt 10 accounts before passing one and then getting funded and making that money back and then went forward, it's a lot better of a position for me to be in than me putting 10K in an account and learning how to trade on that 10K and losing all that 10K and then going out and figuring out how to refund the account. That's the thing I really want to pay attention to, you guys. When you hear these things on Twitter, just focus on what I just went over, okay? Recommended sizes, once you guys get to a place, these are my 3 top ones. I like the 50s. I'm primarily at the 150 and 250 area, but the 150 I feel like is my sweet spot. I usually have a 9,000 profit target and a 4,500 or a $5,000 drawdown, okay? So that's just funded accounts. If anybody has any questions after this, we'll have a Q&A. But going forward, let's jump right into the content. All right, so concepts. The next few slides will break down a few trading concepts that I want you to remember, and I'm going to say this often. These are pieces to a puzzle. Your trading strategy is what pieces the puzzles together and shows you the profits. No concept is good on its own without proper context. And remember, you should never try to trade just off the concept alone, okay? In fact, after watching the lessons and when we get into the models and the things of saying buy here, sell there, higher time frame this, lower time frame that, you're going to come back and rewatch this lesson and you can fast forward to this point right here and just so you can learn the concepts, okay? So getting into it, first one's going to be order blocks. These are often called supply and demand zones. There's a lot of back and forth in the smart money community, SMC, smart money concepts, blah, blah, blah. They labeled these things as order blocks and claim that they came out with it first. For me, it's all the same thing, and I'm not here to say this one's better, that one's better. I'm just here to help you identify and read price. Point of the matter is an order block, a bullish order block is the same thing as a demand zone. A bearish order block is the same thing as a supply zone, okay? So what do they look like and how do you read them? So you're looking for a smaller down close candle, red candle before an explosive up move to the upside. Now be sure to mark where price opened. I call that the point of origin. That's my term. And this will be covered in upcoming lessons that we have as we get more into the harder stuff. All right, so what's it look like? Let's see right here. Here, so I want to bring it. Nope. I need a pen. Here's what I want to bring your attention to. This down close candle. Again, price usually goes like this, right? This swing down on some time frame. Like let's say this right here. Let's say this is a 1 minute time frame. On a higher time frame, it looks like this. Down candle, up move. Okay? All we're looking for is that down candle, big up move. I like to say you get 2 nice bars after the down candle. That's definitely a strong zone, okay? All you want to do is have that and draw the box to the right from the open of the candle to the low of the green candle. And this area here is my zone, all right? Let me go back, sorry. All right, so here's what it looks like in person. This is the exact same example. Same thing here, as you can see, you get the down close candle before a nice up move, and when price comes into it, on a lower time frame, we're looking for a certain model to take advantage of an up trade that offered something else, okay? Now, you can go ahead and look at this chart, and I can identify another one. Here's another one right here. Down close candle, price comes into the point of origin. This wasn't a strong one. Price cuts through. But this right here is your zone. Now, you'll see that this particular zone did not hit because this zone is just a zone. A zone without context, which is structure, is useless. Okay? Remember that. So don't go around just trying to trade every, hey, look, I learned something new today. I'm going to go ahead and try to trade every zone. Don't do that. A zone without context, a fair value gap without context, without structure, none of this stuff means anything. So again, make sure you wait for the rest of the classes before you try to bounce an idea off one of these zones. Okay? So the next part of these order blocks or supply zones is what we call the hammer. So doji candles that form right before a huge move to the upside, that's what we're looking for. So draw from the top of the body for the POO's point of interest, the opening of that candle, and down to the body of the wick. So what's that look like? Here's the hammer. You want to go from here. You want to go from here. All right. This is your zone. Okay. And this was from the last slide. I'm getting ahead of myself here. But this is exactly what I just said right here. But yeah, this is basically, it's the hammer before the up move. Now this is that same hammer. Point of interest is the opening of that candle. This is ES, comes in, you get a nice rally. Now on the lower time frame, again, we're not just buying the box. On the lower time frame, we're looking for certain things to happen. All right. Then this lesson, like I said, is very basic. Just introducing you to some of these concepts. But we're looking for a price to come in with the right context at the right zone. These zones, these concepts are often referred to as what we call point of interest. And we'll get into that later here in these lessons. Now, supply zones, the opposite. We went over demand zones, bullish order blocks. Now we're looking at bearish order blocks, also known as supply zones. Basing patterns just means zones. That's the down close or the up close candle before the move down. All right. So we're looking for the order block itself, the shooting star, also is doji. A doji and a shooting star are simultaneous and interchangeable with each other. So we're looking for smaller up close candles here. Smaller up close candles before an explosive move to the downside. That green candle, that's going to be your order block. Now be sure to mark a line through what I labeled as the point of origin, because we can use that area as an exact level, and that'll be covered as these lessons keep coming out. And you want to draw your box from the point of origin to the highest point of the two candles. So I'd like to bring your attention to, I believe this is ES here. This is going over what it looks like. Again, here's the smaller up close candle. You get the big giant move down, and then again, you get a retest almost instantaneously, and then you get continuation to the downside. It's a 2-candle play. So looking at it again, not only did you get the retest of that same area and the sell-off, you also got another area here, and on a lower time frame, we're looking for price to come back to external range liquidity. But that'll be covered in a different lesson. Now, supply zones from the standpoint of what we call a shooting star, all right? So we're drawing the zone from the top of the wick, which is the opposite of the hammer, right? So we're drawing a zone from the close to the top of the wick. Watch this. Here's the shooting star right here. It's literally like a doji. Here's a doji right here, but turned upside down, okay? So here's the point of interest. You're going to draw that all the way over. And then from the highest point, you're going to draw that all the way over. This is your zone. All right. Here it is zoomed in. Here it is closer. Here's the shooting star. Draw that over. As you can see, price hits it once, sells off. Price comes to that area again, sells off. Price comes into that area, another down move. And it provided 3 different opportunities, again, that you're going to learn about the entry model in the lower time frame coming up, but it provided 3 different opportunities to get short. And again, external range liquidity is what we're usually shooting for. Now, here's a concept, and as we're moving along with this, you're going to hear this one a lot. This is probably FFG. You're going to hear this a lot. Like, this is the where you want to pay attention to. Now, a fair value gap denotes a market scenario when the number of buyers exceeds or falls the short of the numbers of sellers by a significant margin. Long story short, all I'm saying is when price comes in, right? When price starts to move, if price is aggressive, it's going to make that candle move heavy. And when that candle makes a big move, it'll usually create what we call an imbalance, meaning the price was delivered inefficiently. And that inefficiency, that space between the two gaps, that is what we call a fair value gap. I'm gonna get into this in a second. Now on the chart, you'll notice it's a 3-bar formation. All 3 bars are consecutive, meaning it's 1 bar, 2 bar, 3 bars, and candle 1 and candle 3 have a gap between them, and they do not overlay or touch. So what do I mean by that? Here's candle 1, here's candle 2, and here's candle 3. Okay, so the space between the two is a fair value gap. So I want to bring your attention here. If you look here, between these 3 candles, this candle, the top of that candle touches this right here. Top of this candle touches right here. Okay? But in this scenario, these candles have a space. Here's another angle. Candle 1 and candle 3, they don't touch. And they leave that open space from the bottom of candle 1 and the bottom of candle 3. That open space is your fair value gap. And that's an inefficiency in price, meaning sellers came in hard. And when that order, whatever moved it, whether it's an algorithm or sellers, when that happened, it opened up this gap. It wasn't delivered efficiently. So we can look for a retest around that or an inversion, and that can create an entry. And again, like I said, without the proper context, you want to just use these concepts as observation and not something practical to use just yet. So here it is again. It's going to be often annotated with the box. You guys will see boxes on my charts for everybody that's on live stream trading with me, or if you guys are just in the chat room and I start throwing charts around. When you start seeing these boxes labeled as fair value gaps, these are the areas that I'm talking about. Again, 1, 2, and 3. So again, we're going to flip it up and go to a bullish fair value gap. Here's candle 1, the red candle here. Candle 2, the green candle here. Candle 3, the shooting star kind of candle here. The distance between candle 1 and the distance between candle 2. This is your bullish fair value gap. Obviously, going back here, this is your bearish fair value gap. And going to the current slide, this is your bullish fair value gap. Okay? All right, so keeping that moving. Candle 1, if you look right here, candle 1 obviously moves higher and does not connect with candle 3. Okay? So candle 1, candle 2, candle 3. So candle 2 keeps open the open space here. Okay? And again, as denoted before, you're going to often see them being represented by boxes here. So just remember, you can have bullish fair value gaps, and you can go back and you can have bearish fair value gaps. They're interchangeable. And the only difference is one's going down, one's going up, and there are imbalances in price. And as I said before, for my more experienced members, the market's only looking to grab liquidity and rebalance in efficiency and constantly repeat that paradigm. Okay. Inversion fair value gaps. You're also going to hear this one a lot. I personally like these the most for entries. These are actually my favorite kind of entry models. These are my favorite areas in price right now. I want you to think, before I get into this, supply becomes demand, demand becomes supply. I also want you to think support becomes resistance, resistance becomes support. All right? It's the inversion, meaning they ran through each other. So an inversion fair value gap happens when a normal fair value gap loses its juice, right? Causing a reversal in the dynamics of the original gap, meaning that support has now turned into resistance. All right, I'm not talking about actual support and resistance lines on the chart, but it's the same theory. Remember, a bullish fair value gap, a bullish inversion fair value gap. Inversion fair value gaps often typed out IFVG instead of FVG. Now, bullish inversion fair value gap is a bearish FFG with a bullish close above that bearish fair value gap. A bearish inversion gap is a bullish fair value gap with a bearish close below, because it's the opposite, below the bullish fair value gap. Okay. The most important thing about this metric is that you see and get the close. So right here, labeled here, this was a trade that we did take. You have candle 1, candle 2, and then candle 3. Okay. Right here, that open space, this is your bearish fair value gap. An inversion fair value gap closes above. And if price is to retest that support becoming resistance. With this case, resistance becoming support. Only reason why I keep saying that is most people know support and resistance. It's not the same thing, but it's the same theory. This bearish fair value gap has now become bullish, all right, and it's looking to hold price. So this is the bearish fair value gap. Here's that same bearish fair value gap here. And once price, right here, as noted, price closes above the bearish fair value gap, now a bullish inversion fair value gap. Price retests it all, which it did. The next candle here came in. It gives you an entry. Now, I'm not saying go ahead and do that just yet, but this is pretty much where you're at. You're looking for the close above the bearish fair value gap. That makes it an inversion. No close, no inversion. Here's a live example of another one. So this right here is a bearish fair value gap. Price closes right here. Now it's a bullish fair value gap. You got your retest after the sweep. There's your entry to the moon. Technically London highs, right? What I just said on the back end of this, you don't have to worry about that. But right now, all I want you to worry about is finding these fair value gaps and the inversion fair value gaps. So one thing that you guys can start to do if you're really serious about trading is to go back and back test. Well, in this case, identify, use old data, Friday, Thursday, Wednesday, whatever it may be in TD Ameritrade's replay mode. You can go back and look and just point out where is the fair value gap. Looking at this chart, can you see a fair value gap? Here's one right here. Here's another one right there. Go down here. There's another one right there. Okay. These are the type of things that you want to go do. Do you see any more inversion fair value gaps? Now to this side, again, I'm not saying you would go and trade every one of these fair value gaps. Again, context is everything. Without context, not. But right now, I just want you to identify these structures, okay? Kill zones. The next part of the concepts I want to bring in. Time in price is a thing. I know if you guys follow Twitter and the crazy things that go on Twitter, YouTube, and the arguments of traders between this topic is crazy. But I'm here to tell you that time precedes price. Price and time, they go together, okay? So kill zones refer to a specific times during the trading day when market activity tends to be more volatile. And because of that, it's more favorable for day trading. These periods of times often coincide with key market opens and they overlap, or markets overlapping, meaning London and New York are both open at the same time. This is where we can find an edge because there's more volume inside of this time window. So for me, my preferred areas of trading is the New York AM session. For me, I'm going to tell you something straight up. You're going to see more consistent flow between this time. Not to say, you don't get other times, price action during other times, but the New York AM session, if there's a big move that happens between all three of these, 8 out of 10 times is going to come from the New York AM session, 8:30 a.m. to 12 noon, okay? But don't trade between 12 and 1:30. Most days, there's consolidation. Not to say it can't happen. There are some times with 12 o'clock, you do get a nice move, something happened, or, maybe price expanded. I'm going to give you some tips on that here in a second. There are some times the New York lunch session is there, but more often than none, it's very choppy. The New York PM session is going to start between 1:30 and 3:30 p.m. London, I do not trade, but in our chat room and on our crew, Mr. Rapid Repricing is a huge London fan. He's there every day between 2 a.m. and 5 a.m. And then all these times, and again, on your charts, I highly recommend, because a lot of us are screaming times and areas. Like we'll say on audio feed, I might communicate something to you very fast. Watch the inversion gap from 3:23 p.m., extended all the way to the right, and at 3:50, we got the retest. It's very important that you have your charts on TradingView tuned to the New York Standard Time, because I'm going to be communicating what I'm seeing in that particular manner. So make sure you have that, okay? Now, a couple things to note. I told you that I do prefer the New York AM session, but if we get an expansion move overnight in the London session, so 5 a.m., market's up 120 points, I'm going to prefer the New York PM session over the New York AM session, because you're going to have to let that consolidate, and vice versa. If New York AM session extends really heavy, I'm not even going to look at the New York PM session unless I'm looking for a reversal, okay? If you miss a move on the AM session, either skip the day and come back, or come back for the PM session, okay? And a lot of times, if that AM session is just crazy like that, I'd be looking for a reversal in that PM. or some form of continuation. Okay. So just to recap all of this, funded accounts are a way to de-risk and speed up your trading career. But the goal is to fund your own account with that money. So theoretically, you took a funded account, earned some money from that funded account, and you placed it inside your own, which I recommend, a NinjaTrader account. And then theoretically, you never invested that money, so you have no emotional attachment to the money inside of that account. Now, the concepts, again, we just went over a few concepts. And again, like I said, concepts are nothing without the method behind them. No model, no entry. No structure, no entry. And no setup, no trade. You need to have proper context. I want you to understand that this is a very foundational block lesson. And these are just the building blocks that we will continue to expand on over the next 60 to about 65 days that we'll be working on this here. So without further ado, I want to just say thank you guys for your support, for supporting me along this endeavor. I want to go ahead and open this up to any questions that you guys may have. I do see a lot of more of my experienced people in here. What's up, RN? What's up, Bless? What's up, Joe? What's up, Karen, KT? Hope everybody's well. Now, on the Zoom stream, you're not going to see what questions people have. But if you guys can look through and see the mentorship chat, if you have any questions, let me know. If you're all good, hit me with a 333. So I'm getting a couple 333s. Any questions at all, let me know. What's up, Chewy? I didn't see. We'll address that here in a second. All right, so it looks like we're good. Everybody that's here, stay on. But for the recording purposes, we're going to go ahead and tune out. Now, coming up next, we're going to be having in the very nearby future a lesson on market structure, liquidity, an external range, and an internal range, all in the same lesson. That'll be lesson 2 here in the masterclass. Besides that, guys, I appreciate you guys for your support. If anybody has any questions, feel free to reach out to us. And again, if you're on the team, we'll see you guys at the same place, same time every morning at 8 a.m. In the New York AM session live stream. Again, thank you for your support and have a great day.